So, welcome everyone to this lecture in accounting. I'm sorry that with this very short notice, I had to do the session online only. It's just, yeah, I got a little cold, so I don't want to pose any risk meeting any of you. Okay, so for now or for today, we have two things. Second of all, what you see behind me, the specific aspects of accounting that we will get into chapter 5 today. But first of all, we will get into the accounting cycle exercise, which I uploaded last week. So, and I hope did not pose that much of a challenge to you. So can I just get via audio or in the chat just a quick answer how you if it was very difficult for you to answer these tasks or to get through this task, or if it was very hard. So was it very difficult or was it easy? Okay, so apparently no answers yet. So does that mean that no one attempted to do the exercise? Some were easy, some were hard. Okay. Which ones were the hard ones for you? Okay, so we will just go through those exercises quickly, and just keep in mind that any of these exercises on the accounting cycle might be relevant for the exam, as the accounting cycle is a huge part of our lecture, obviously. Okay, so we have the accounts of Kurt AG in an alphabetical order with their current account balance. There are no other accounts in the general ledger, and all transactions are recorded to these accounts. So you are not to use any other accounts that might seem relevant for you. And we use an accrual-based accounting system. All amounts are given in euros. Okay, first of all, we have all these accounts here with their account balance. We are the accountant in charge of recording additional transactions to the general ledger, and all of the end of period entries and adjustments. Now we have some more specific tasks. So first of all, it isn't mentioned here explicitly, but we will just construct the trial balance at the point in time with these accounts that are given here. That is not strictly necessary, but it makes the job a little easier for recording the transactions later. So we have here the list of accounts. Just a second. So we have here the list of accounts with their current account balance, and also then on the right here, the trial balance from the starting point. The trial balance is ordered with assets first. So we have the asset accounts first. Up to here. Then we have the liabilities accounts. Then we have dividends, then revenue, and then expense accounts. So this is the order of the accounts on the trial balance. These categories are important, but not so much the order of the accounts within that category. So assets first, then liabilities, then dividends, then revenue, then expense. That's important. Whether you have cash or accounts receivables first is not that important. Okay, so now we have the trial balance as a starting point, and we have the trial balance separated by debit and credit. On the debit side are all the debit accounts. On the credit side are all the credit accounts. So all the debit accounts are those that raise when you debit them and decrease when you credit them. So cash increases on the debit side and decreases on the credit side. So we have cash as a debit account here in column E, or in the debit column. And as we can see, that sum of accounts over here has to balance. So in this case, all accounts balance, which is good for our trial balance to balance. So now we can go on. We don't have any mistakes in here, and we can go on to our accounting entries. So first of all, it is December 31st, 2022 for all these transactions, and the following transactions of the fiscal year 2022 have not yet been recorded to the accounts. Construct the necessary journal entries or entry for each transaction and adjust the corresponding account balances. Number A, Kuwait AG took out an additional loan of 10,000 at the start of the year. The yearly repayments amount to 1,000, yearly interest to 200. Someone with the correct accounting entry, please.
The first one will be bank loans to cash 10,000.
Bank loans to cash
10,000.
10,000. Those are the correct accounts. Yes. We have loans and we have cash. That's correct, but we have to have that the other way around, because we raise cash, we take out a loan. We take out a loan and have we take out a loan and get the money to that into our own bank account. So we raise the cash account, and we do that on the debit side. So the accounting entry down here would be cash to loans 10,000. So we have cash 10,000 on the debit side and loans 10,000 on the credit side. That is the first one. After that, we also have in the transaction, we have also given the yearly interest and yearly repayments. So the yearly repayments reduce the loan and reduce our cash. So we just reverse that accounting entry and have loans to cash 1,000, which reduces our cash and reduces the loan liability to 9,000. And then also we have the yearly interest rate of 200, or yearly interest payments of 200, where we then have interest expense to cash 200. So interest expense is an expense account, obviously, that raises in the on the debit side, and cash again is reduced on the credit side with 200. Those are the three components that we have in this transaction when we take out a loan. You can also put these two transactions, the repayments and the yearly interest payments, under the category of adjusting entries. That is also fine. Just don't get confused where you put it, if you put it somewhere. Just put it into the accounting entries, either in this category here in the first part, or in the adjusting entries afterwards in the second task. Okay. If there are any questions, please utilize the chat or just speak up, please. Otherwise, I'll just go through these transactions. So on January 1st, Kurt AG bought a new production machine for 15,000 with an expected useful life of 10,000. We paid for that in cash. Anyone wants to answer that one?
PPE to cash 15,000.
Yes, perfect. PPE to cash 15,000. Yes. And we can also do the accounting entry for the depreciation at the same time. That would then
depreciation to PPE 1,500.
Yes. Let's see. So we have this one is under the category of the accounting entries, but yes, of the adjusting entries over here. So we have PPE to cash 15,000, and then we have depreciation to PPE, which I put over here for task 3 for the adjusting entries. But as I said, that's also fine if you do it in this category here. But yes, perfect. Those are the two accounting entries for transaction number B. Okay. Number C. On December 20th, 2022, a customer bought finished goods for 4,000. She received an invoice to be paid on January 20th, 2023. The book value of the finished goods was 3,000. So what might the accounting entries for this be?
Revenue sales to receive invoice for 4,000, and PPE and decrease to PPE, decrease in finished goods to finished goods.
Yes, the second one was perfect. Decrease in finished goods to finished goods. Yes. The first one, we have the other way around. Revenue is a credit account, and we have to credit that to raise it. So we have on here accounts receivable to revenue for 4,000 for the amount the customer paid. And then we have a decrease in finished and unfinished goods to finished goods inventory, 3,000. So what would be the income statement effect of this transaction?
We make a profit of 1,000.
Yes, perfect. Very good. That would be the profit of 1,000. Okay. Then number D, during the year, unfinished goods with a book value of 5,000 were manufactured to finished goods with a value of 7,000. The corresponding cost of material and any other cost has already been recorded to the appropriate accounts. Any ideas for this
Decrease to unfinished goods 5,000 to PPE, and then increase in finished goods to finished goods 7,000.
The other way around, we now raise the finished goods. In this case here, we have a little trick with the account because we have the account that's called decrease in finished and unfinished goods. Keep in mind only to use the accounts that are specified in the task. So we raise the finished goods by 7,000 and we reduce the unfinished goods by 5,000. So that leaves a difference of 2,000, and that is included then in an account that can either be called increase in finished and unfinished goods. So we increase that revenue account, or on the other hand, we can also decrease the decrease account. So we reduce our expenses because of this. This is something that is often used and which I've used throughout the lectures the past semesters, which I won't be using in your exam. So look out for that. We have separate accounts for that. In this case, we have that aggregated. So we have an account increase and decrease together. We collect that. Typically, that would be called, in our case, for this semester, it would be called increase. That would be the account increase in finished and unfinished goods for 2,000 then. That has the same kind of effect on the balance sheet and the income statement, but it's just a difference in the naming of the accounts. Okay, but as we don't have an separate increase account on here, we have the decrease, we have to utilize the decrease account, decrease in finished and unfinished goods, and have to reduce that one. Okay. So now we prepare the next trial balance from using the account balances from task 1. And we have that here.